Good afternoon, everyone, and welcome to the third episode of Money Talks, a four-part mini-series hosted by UCD Alumni Relations. My name is Dr. Anita Suurlaht, Assistant Professor in Banking and Finance at UCD College of Business. This series was put together to support UCD's large community of alumni and friends to learn some valuable tips across savings, health insurance, mortgages, and investments. Today's session will be extremely helpful for those of you starting on your mortgage journey. The format for this lunchtime includes a 25-minute presentation, followed by a Q&A session, and we plan to wrap up by 12:45 p.m. And please submit your questions on the dedicated Q&A function and not the chat function. And we will try to get to as many questions as we can. So now it is my pleasure to introduce our guest speaker today, Eoin O'Connor. Eoin, also known as the Mortgage Guy on his popular Instagram page, is a financial advisor at Finance Solutions, where he specializes in mortgages and helping his clients achieve their dreams of owning their own home. So I will hand it over to you, Eoin, and we're looking forward to your tips and advice.
Thank you, Anita. Also, thank you to Alumni for inviting me on this series. I think it's a topical subject to talk about, and I think everybody has an interest at the moment, whether it's mortgages or the housing sector in general. So yeah, I'm going to start my presentation. I suppose you might as well start with a quick intro to myself. So I'm a financial advisor over 10 years, currently based in Finance Solutions, where I've been a mortgage broker over the last 10 years. I have a huge passion to help people on the mortgage journey. Previous to this, I worked, as I said, in a large retail bank where I did a lot of lending, customer service, etc. But I found my passion for mortgages, and that's why I eventually moved into the mortgage broker market. I suppose Anita mentioned it there. I set up my own page on Instagram there on the initial first lockdown to help people on their mortgage journey. It's now gathered 18,000, just over 18,000 followers. So it's a huge following with huge demand. But I'm happy to provide that, whether someone goes through myself or whether they go to direct to a bank or another broker. I'm happy to help them out, because it's all about helping people on their mortgage journey and getting their dream home. So, question is probably the most common question I get as a mortgage broker: why choose a broker? Well, it saves you time and money, first of all, because if you go direct with your own bank, they'll tell you how great their product is. So my answer to that is why choose one lender when you can choose 8? And my job is to, I suppose, gather your information, find out your needs from a mortgage perspective, and make some recommendations. So it's about finding the lender that meets your needs. And we've access to all leading lenders and find the lender that meets your needs best, whether that's finding the lender with the lowest rate out there, whether you are interested in the cashback option, which lender allows you flexibility to overpay, etc. Doesn't cost you a penny. Okay, Finance Solutions, we don't charge a fee. All brokers get paid by the lender. It's the same amount by each lender, so we're not biased towards any particular lender, but it doesn't cost you a penny. Some brokers do charge a fee, but we have Finance Solutions, we don't charge a fee. It's more personal. I'm with you every step of the way. So from our initial consultation, when we're assessing your mortgage needs, until you finally get your keys, I'm literally with you every step of the way. You have my direct mobile number, my direct email. So yeah, some people love it. They just find it a lot more personal. You're dealing with one person from the start to the finish. Once you draw down your mortgage, unfortunately, you're on your own, and all you need to do is pay your mortgage, and everybody's happy. So your client for life, it's a very kind of open kind of statement. But it's the way we view our clients. We don't just allow them to draw down the mortgage and say, best of luck for the next 30 or 35 years. We want to look after financial needs throughout their lifetime, and especially if there's any changes from the material facts from the initial application. So generally, an example of that would be, is if you drew down on a 3-year fixed rate. The lender that you drew down on may have suited your needs then, but in 3 years' time, your circumstances may change, or that lender may not be offering you attractive rates anymore. So I'll generally set up a call to cover off what that lender's offering you now, and advise whether to go fixed back in on a fixed rate, on a variable rate, or if there's better options out there, I'll advise on that, and I'll be doing that throughout the lifetime for you. And then protection needs. I don't only look after your mortgage, I look after your mortgage protection, and mortgage protection is a policy that you need to draw down your mortgage, and it's a policy to match your mortgage amount and your mortgage term, that if you and your partner pass away during the mortgage term, that policy will be there to clear the mortgage. Protects you and protects the bank. We also look at life cover, serious illness cover, income protection, and we look at home insurance. So it's not about just getting you the best deal throughout the mortgage term. It's about looking after and getting your best needs through protection in regards to mortgage protection and home insurance. So, first-time buyers, how to be mortgage ready. And this can apply to second-time buyers and anybody thinking of moving either, you know. But it's just a few tips there on how to be mortgage ready. So, when you're applying for a mortgage, the bank wants you to have a regular income. Okay, so if you're a PAYE employee, you generally need 3 months pay slips, and you need your employment details summary from last year, which replaced the P60, and that can show your earnings from last year. And I'll be giving you a salary cert for your employer to fill in to break down your occupation, when you start, and what company you work for. And if you're self-employed, a lender will generally look for your 3 years audit accounts and a letter from your accountant confirming your tax affairs are up to date, or a tax clearance cert. As a first-time buyer, you need a minimum of 10% deposit. So if you're buying at 300,000, you need 30,000 of a deposit. That can come in a number of ways. That can come in the form of savings. It can come in the form of a gift from a family member if you're lucky enough that a parent's willing to help you out, or the Help to Buy scheme. So the Help to Buy scheme came out there a couple of years ago, and it's for people who are either doing a self-build or buying a new home, and you have to be a first-time buyer. And what it is, it's a rebate of your last 4 years income tax and dirt tax up to a maximum of €30,000. So if you're buying at 350, you could get up to 30,000 of your deposit from the Help to Buy scheme if you're buying a new build and you're a first-time buyer, and then you just have to put 5,000 of your savings towards that to cover the full 10%. So it's very good. It's called a Help to Buy scheme, but it's only available for first-time buyers, and it's only available on new builds or if you're completing a self-build. Repayment ability. It's quite important. You can have the other two, and you may not have the third one, which is probably the most important. So if you qualify for the mortgage you need, you have the income and the deposit, you need to show you can afford the monthly payments for a minimum of 6 months before you apply for a mortgage. And a way you could do that is through your rent. So bear in mind, if your rent is going out of your account each month, you need to show that monthly payment can go towards your affordability, because when you buy your home, obviously you will not have rent anymore. So rent, everything going out of your account can be one. Regular savings could be another. And then the third thing could be if you plan on finishing up a personal loan prior to drawing down your new mortgage, and that loan payment could be obviously used towards repayment ability. But the general top two would be regular savings and rent. So an example of that is if your monthly payment's working out at €1,200, if your rent is working out at €1,200 more, or your savings are €1,200 more, or a combination of the two, if they're working out at €1,200 or more, that's your proven repayment ability, and the bank's satisfied then. Accounts in good order. This is a very broad question as well. What do I mean by that? You're not basically showing any financial pressure on your accounts. So you're not missing direct debits, you're not getting missing standing order fees, you're not going overdrawn in your account, so you're constantly in the minus. You're showing financial pressure. And a big thing, and yeah, it's quite a controversial topic, the banks don't like betting through the account as well. So I'd advise you, if you are having a bet, go down to the bookies and keep it out of the account, and any kind of reckless spending. But the one thing I want to point out on that is the bank does expect you to have a life before and after your mortgage. So don't worry about, oh Jesus, the bank have seen McDonald's coming out my accounts twice a week, I can't show them that. Or there's online shopping for boohoo.com or lifestyle sports, I can't show them that. Bank expects you to have a life, they're human at the end of the day. So yeah, don't worry about that. Mainly, you're not showing financial pressure on your account by going overdrawn and missing direct debits, and no betting going through the account. Clean credit history. This is quite topical at the moment. I suppose clean credit history means no missed payments on any loans, credit cards, or if you're a second time buyer, your existing mortgage payments. And this is crucial. And I've actually had a few cases over the last while where there have been issues. For someone who had a credit card from years ago when they went to Australia for a couple of years and forgot all about the credit card. Now they're coming back, the income's perfect, the repayment ability is perfect, the deposit's perfect, and then they forgot about the credit card and the bank wrote that credit card off. And that's an issue from a lender perspective. So credit history is huge. What I would say is, if you do have any issues within the last 5 years, it's best to meet with your broker, meet with your mortgage advisor, and be upfront with them. You can order your own credit check through icb.ie or Central Credit Register. The links are there. It's free to inquire, so there's no reason why you shouldn't or organise that. But it's crucial. As I said, the fact that it's free, there's no reason why you shouldn't do it. And plus, you'll be giving yourself your own. You'll be giving yourself peace of mind that you know when you submit the application, your credit history is going to be perfectly fine and nothing's going to happen. If there is a credit history issue, I deal with it every day. I'll be able to advise whether it's an issue with one lender or another and advise you how to proceed from there. But yeah, I think it's very important to get that. As long as you have those 5 points, you shouldn't have any issue getting mortgage approved. Documents in order. So as I said, 3 months pay slips. You'll need a salary cert. You'll need your employment details from last year. 6 month statements on every account. So credit union, credit cards, savings accounts, current accounts, Revolut, believe it or not, they do ask for your Revolut and N26. So 6 month statements on any account that you have, 12 month statements on an existing mortgage if you have it, and 12 month statements on any loans. And then it's just your photo and address ID. They're generally the documents we look for. So step-by-step guides to getting your mortgage. So getting mortgage ready, you need to, I suppose the main thing is pick up the phone. You know, there's no point listening to friends, family, work colleagues telling you what you need and don't need for a mortgage. Ask the people that know and deal with it every day. Pick up the phone to a mortgage advisor and broker. So you need to see how much you qualify for. Then if you qualify for the amount, do you have 10% deposit? Can you show affordability for the monthly payment? And have you got any clean credit history? So I kind of covered that off in the last one. Submitting your application. So once I assess your needs, I will make some recommendations. The final decision will be yours on who you go with in the end. But I suppose it's about presenting options to you. Now, you may come back and say, I'll go with that lender because they have the best rate, or I'll this lender because they have cash back. You know, or a lot of people now with house prices the way they are, a lot of people are simply looking for which lender will give me max lend. So I present you with options. Once I present you with options and you finalise who you want to proceed with, I'll send you an application form to sign. I submit the application. You generally hear back right now around 2 to 3 weeks for approval. So yeah, once you get the approval, you have it there for 6 months. So the best way of I explain it to customers is you 6 months then to find a property. Once you go sale agreed, it's extended then again by another 6 months. So you've technically, with most lenders, a year to draw down your mortgage. So 6 months up front, that gives you an option to go sale agreed in the property. And once sale agreed, you pay a booking deposit, which is usually around €5,000. It's fully refundable, and that €5,000 deposit goes towards your overall 10% deposit. And then you need to finalise that stage, what rate you want to proceed with, what term you want to go ahead with, what the final mortgage amount is, etc. Okay, and once you do that, I send that on to the lender. And they'll organise a valuation. Evaluation will cost you around €150, and the lender just wants to make sure the house you're buying or the apartment you're buying is worth the money you're paying for it. Once that's done, I said you've identified a property, we're finalising everything, and then the closing process is literally, I need to make sure when contracts go out to your solicitor and when the loan offer goes out to your solicitor, I need to make sure there's 4 things in place. One, you have your mortgage protection, and mortgage protection once again is policy in both your names that clears your mortgage in the event of death, so the debt's not left to the other person. We need home insurance. We'll get you home insurance. That's basically protecting your asset. We need to have a direct debit mandate signed, so where you're going to pay the mortgage from. And then any kind of conditions the lender puts on prior to drawdown, that needs to be met as well. And then it's just a case of your solicitor requesting the funds. And once your solicitor requests the funds, I'll be ringing you with the good news, telling you you're a homeowner, and then you generally get the keys within 24 hours, because once the funds leave the bank, it goes to the solicitor, and then the solicitor has to transfer it to the vendor solicitor. So that's the person you're buying off in this instance, and then you get the keys upon receipt. So look, it sounds very simple. Obviously, with COVID and the market the way it is, there can be a few little obstacles in between there. But that's just the general synopsis, this quick guide for you. So the current market, so yeah, I think it's all over the media. You don't have to be a mortgage expert to know there's a huge increase in mortgage applications. So it kind of defies logic right now. The way we're in the middle of a pandemic over the last year, with people losing jobs, businesses closed, but there's still a huge demand. And I can safely tell you, from the amount of hours I've done since the 3rd of January, there is a huge demand out there. And I as I said, it's a huge demand, and I suppose there was, when initially lockdown happened the first time, there was a worry in regards to, is there going to be a drop in house prices? Well, the answer is no, and we can see there hasn't been a drop since the initial lockdown, which has probably surprised a lot of people. But there is a huge number in the amount of applications. It's driven by first-time buyers. So you can see there over 50% of applications are driven by first-time buyers. And then the value of mortgage approvals in 2020 exceeded 10 billion, and that's definitely going to increase, especially with the demand out there. Okay, so what's causing the increase? Well, definitely when the stimulus package came out last July, the Help to Buy increased from a maximum of 5% of deposit up to 20 grand to up to 30 grand, up to 10% of your deposit. So think about it. If you're buying a new build or building for 300 grand or less, you could possibly, as long as you pay enough income tax, you could possibly get your full deposit from the Help to Buy scheme if it's a new build and if you're a first-time buyer. So that's certainly put a lot of people in a position to move now versus they were planning on moving next year and building their deposit. So if you're buying a new build, it's put a lot of people in a position now. And then savings. So okay, we're well aware of the effects COVID's had on people's incomes and employment, etc. But I suppose if we've had no holidays, pubs, restaurants are closed. If your income hasn't been affected, it's a controversial statement, but you've probably saved more than you have in the last year than you've ever done. And obviously that's got people on mortgage ready a lot sooner, along with the Help to Buy scheme. And once again, it's all over the media about deposits are at an all-time high with the banks. And I know there's credit unions introducing limits on the max savings they can hold, and obviously deposit rates are quite low. You're getting 0.02% on a 1-year fixed at the moment, which is no good. So these two factors are probably the main reason why there's an increase in applications. And then the result, look, once again, it's all over the media about house prices. There's a lack of supply. So in regards to the lack of supply, the central bank have stated we need to build a minimum of 30 to 35,000 a year to cope with the demand that's out there. Last year we built 20,000. Now that actually figure wasn't too bad in regards to the multiple lockdowns that we were in, that we got 20,000 homes built. But just to give you an idea, in 2007 there was 50 to 60,000 homes being built a year. So there's a huge difference, and this is a big thing that I suppose I don't like when people are saying, oh, I'm expecting a crash, or this is like 2007. It's totally not like 2007. There was over 40 billion lent in 2007. There was less than 10 billion last year. There was 50 to 60,000 homes being built a year, and last year there was 20,000. So it's not like 2007. But I suppose, as I said, the figures are there in regards to what we need to build per year. And as I said, we need to come up with incentives to solve the lack of supply on the market at the moment, and there's so many different people with opinions, but we need action, I suppose, sooner rather than later, because we're seeing house prices go way above the asking price. So yeah, we need to do something there. So how it's affected it? Halt construction. I mentioned there, we needed to build 25 to 30,000 homes. We built 20,000 last year, so that's obviously affecting the market, and as I said, affecting housing supply. Income and jobs have been affected. So I suppose look at the PUP and the wage subsidy. So the lender's stance on that is, I suppose, if your employer's on the wage subsidy, they're on the wage subsidy for a reason. Their profits have been affected by 25% or more. So the concern from the lender and their stance on it is that you cannot draw down your mortgage if you're on the wage subsidy. Now, one thing I will say that is the banks are getting hammered on this, and in regards to the 3.5 times income limits, but the banks have to be prudent in their lending, and they got a lot of stick, I suppose, 10 years ago, and further back in regards to giving out 100% mortgages, not having any cap on the amount they could lend, and now they're actually being prudent. And the whole point around the wage subsidy in regards to lending is the lender wants to make sure they're not saying they won't lend you the money if you or your employer on the subsidy. They're saying, hold on, we just want to make sure that your income that we've assessed you on is going to remain the same. And look, at as long as we get comfort around that, we're more than happy to lend. So I don't think I've had an issue with applications at drawdown stage. But yeah, look, the banks will do everything we can, and I as a broker will do everything I can to get it across the line. But certainly people's applications have been affected when they were on the wage subsidy or their employer was availing of the wage subsidy. But we need to look at that as a broker and make some recommendations there. So added risk factor for insurance companies. So not only from a mortgage application point of view in regards to income, there's a risk factor that when you're getting your mortgage protection, if you have an underlying condition, the banks are not the banks, the insurance companies are a bit more cautious when underwriting your cases. So normal applications that may have got approved previously or loaded as in an increased premium was applied have either been declined or postponed because of COVID, because there's more risk there that if you do have an underlying condition, obviously there's a risk there, and it's self-explanatory of why they're doing it. And so there's those kind of challenges that we're looking at, and that's the key thing to liaison with a broker, is to make sure we have everything straight on the table. We're kind of making good advice and making recommendations, and obviously the aim from the bank's point of view and my point of view is to get you into your new home. So despite all this uncertainty, there was over 43,151 mortgages approved in 2020, and as I said, there was just under 9 billion lent last year. I think it was drawdowns 25,619 cases drew down. So despite all these challenges, there was a lot of drawdowns and a lot of mortgages approved, and I've continued to see this so leading into 2021. So I suppose my 3 top tips in regards to this is know your budget. The main advice I'd give you. The whole point of this presentation is there's so much information out there in regards to mortgages, but I want to kind of break it down simply for you, that after this presentation you feel more comfortable either approaching a mortgage broker or a mortgage advisor and getting a better understanding of the mortgage process, that you feel, do you know what, it's actually not that scary to apply for a mortgage or approach an advisor and get some information, because it's not, it's easily broken down, and it's my job to kind of break that down and work with you to find the lender that meets your needs and get you the mortgage you need to buy the dream home, hopefully. So first step is find out how much you qualify for. There's no point you looking at a property for €1 million on Killiney Hill and living the dream, and then your income's nowhere near enough to get you the mortgage you need. So before you start looking on myhome.ie or daft.ie, find out how much you qualify for. General rule, well, it's the central bank rule, is they'll give you a maximum of a 3.5 times income. Okay, but there are exemptions to this rule. So give me 2 seconds. So an exemption, what's an exemption? So an exemption is when you're looking for more than 3.5 times salary. Some lenders will go up to 4.5 times salary. Some lenders probably won't go past 4.2 times. Every lender is different, and this is why you should deal with a broker. So we deal with 8 different lenders. Your bank may say one thing. I deal with 8 different lenders, so I know the criteria inside out. So an exemption is basically you're applying for more than 3.5 times your salary. The lenders can only pass 20% of their loan book. So that means 80% of their loan book must be the 3.5 times rule. So the banks have their own criteria on who cannot apply for an exemption. And I suppose with the housing market the way it is, a lot of people are looking for the exemptions, but I suppose it's my job to manage expectations as well when I get all your information to see if it's a possibility. If it is, I'll certainly make a recommendation, but if it's not, I'll be advising you of your options, and then it's up to you on how you proceed from there. get your credit check. If any of you follow my Instagram page, The Mortgage Guy, I keep harping on about this, and I'm sure people are sick of me talking about it, but you would not believe how critical your credit history, a clean credit history, is to a mortgage application. Now, that's not saying that if you've any missed payments in the background, or you had something from 4 or 5 years ago, that you're not going to get mortgage approved. That's not what I'm saying. I've got plenty of cases passed and approved and drawn down with credit history issues. But it's kind of advising me up front, because once I submit the application, it's the lender that does the credit check. So everything could look perfect, and then they do their credit check and come back to me and advise me. They advise me that something's an issue. So the main thing is get your credit check. There's 2 websites there, icb.ie and centralcreditregister.ie. It's free. There's no reason why you shouldn't get it done. And if you have any concerns, reach out to a mortgage broker or a mortgage advisor if you don't understand it. But generally, as long as there's zeros, there's ticks, and or it's down a C on each profile, you should be fine. If you're uncertain, get that and reach out to a mortgage advisor or broker. And as I said, this will show any current credit facilities or facilities paid back within the last 5 years. Believe me, if you have any credit history, don't bury your head in the sand. It will not go away, unfortunately. It will stay in there until it's paid back. So even if you think everything's fine, get the check, be prudent, and give yourself peace of mind when you're approaching a bank or a broker that you have this boxed off. Don't settle. The worst thing you could do is panic. Your gut is always right. You're probably going to be in this home for 20, 30 years, possibly for the rest of your life. Always go with your gut. You'll know when you walk into a property whether it's right for you. Does the property tick most of the boxes you were looking for? You're not going to walk into a property and it's going to tick every box. Keep an open mind, obviously, but if it meets most of them, then put your bid on with the estate agent and try to go sale agreed. It's the biggest financial commitment you will ever make, so make sure it's the right one for you. And yeah, like anything, if you're unsure of anything, you can contact me through www.financesolutions.ie or on Instagram at The Mortgage Guy. And as I said, I'd be glad to help any of you. If you have any questions, feel free to reach out. But hopefully you found that beneficial. I know mortgages in itself can be quite scary, and I suppose, look, everyone has an opinion on mortgages, and the worst thing you could do is be put off touching base with a mortgage advisor because a friend advised you this or a work colleague advised you this. You'll only know when you pick up the phone. So reach out, whether it's me or whether it's another mortgage broker or advisor. Reach out, get the answers you're looking for, and then go looking for a property. But at least crucially, you'll know the answers and when you reach out. And look, we can go from there. All right, guys. Hope you enjoyed that, and any questions, let me know.
Thanks so much, Eoin. We have a lot of very good questions come in. So one of the questions that are coming in a lot is about temporary contracts. So there is, could you talk about, is it possible to apply for a mortgage if you're on a temporary contract, especially on a part-time basis? And is there a difference if you're applying with a co-applicant, or like a husband or a partner, or single?
Yeah, so I actually, my last post on the Mortgage Guy page was actually for contract workers, because it is quite a popular question. And in regards to that, yes, you can get approval while on a contract. So the main thing the lenders look for, so I mentioned there when applying for a mortgage, you need your salary cert, your 3 months pay slips, and proof of earnings from last year. What I ask all people for when they're not in a permanent position is a copy of your CV. Show the lender your qualifications, give them that comfort, show them your experience, that if this contract's not renewed, you could easily find employment based on your qualifications and experience in that area. So that's your CV. I always ask for that when someone's not permanent. I ask for your last 3 years P60s. The reason I ask for that is consistency of earnings over the last 3 years. So yes, although you're not permanent, if you have consistency earning at that level, then that's going to give the underwriter comfort as well. And then a copy of your contract. So your most recent contract, to see what the duration is, how long it's left, etc. And if you can get anything else from your employer in regards to what will happen after that contract, will you be offered another one? Will you be permanent? You know, if you can get anything from your employer, it obviously helps and makes my job a lot easier. But those are the 3 things I generally ask for. Does a second person with a permanent job help? Certainly it does, because I suppose they're in a permanent position, so there's no kind of issues from their side, from their point of view. But I wouldn't be put off holding off until you get until you're permanent, because there's plenty of industries, the IT industry, engineers, etc., pharmaceuticals, the norm is contract work, you know. So the first thing I'd say is pick up the phone to a mortgage advisor or mortgage broker, and we can give you that advice and guide you through the process. But those three things: copy of your contract, 3 years P60s, and a copy of your CV. Get them, and that should give the underwriters enough comfort to get you the mortgage you need.
That's great. And applying for a mortgage if you have lived abroad or you're not from Ireland originally?
So that's fine. One, look, it depends how long you're living in Ireland. You could be living in Ireland 2 years, you could be living in Ireland 20 years, you know. The main thing is you have a permanent income, you have your 10% deposit, you can show affordability through your rent or savings, you have clean credit history, and your accounts are in order. Now, if you have accounts abroad, the lender will ask for 6 month statements of that. They will also ask for a credit check from that country, because Irish banks can only order a credit check in Ireland. So if you have, I don't know, you're originally from the US and you have statements there and you still have accounts there, the lender will ask you to organise a credit check, which you can get from websites like www.experian.ie or www.equifax.ie. You can order your own credit check, and once again, the lender just wants to make sure that you've no borrowings in that country outside of Ireland, basically. And if you do, how are they repaid?
And do you have information whether it's possible to avail of the Help to Buy scheme if you have been living abroad?
Yeah, so this is it's a great question, because a lot of people think, oh, I'm not here 4 years, or I'm not paying tax 4 years, I can't get it. It's based on your last 4 years income tax, but if you're paying income tax over the last 2 years, you're still entitled to claim it. It mightn't be the full 30 grand, but if you get 10 or 15 grand back, it'll certainly help you get on the property ladder. So even if you're paying tax in Ireland a year, you can still apply for the Help to Buy scheme. Okay,
that's great. And we had a question regarding your last slide, the 3.5 times gross income.
Yeah.
Are exceptions to get more than 3.5 times income common?
Yeah. The consensus out there is that all banks open at the start of the year, and literally everybody goes into their banks in January, but like, give me an exemption. No, the lenders open throughout the year. So they do open kind of at January, and then they open and close throughout the year. Some stay open and some just close when they've used their exemptions. Because bear in mind, so first of all, there are exemptions available, okay? And it's up to, I suppose, reach out to your mortgage advisor or mortgage broker to see if you're entitled to them, you know, because every lender has their own rules, okay? This is why we deal with 8 different lenders in Finance Solutions. So I suppose if I can't get you an exemption with one lender, we may with another lender, but there are exemptions available. The main thing the lender would want to put yourself in the best position to get an exemption is to have a clean credit history, strong income and strong savings, and your accounts in order. That'll give you the best possibility of getting an exemption. And you do need a property identified. Sorry, I should have added that in. You do need to have a property identified when seeking an exemption. The reason the lenders want you to have a property identified is, bear in mind, they only have 20% of their loan book for exemptions, so they don't want you just holding on to an exemption and not using it. They want people that are either sale agreed or looking to go sale agreed to come to them when they actually need the exemption.
Okay. And Frank has asked us, what is the difference between interest rate quoted and annual percentage rate of charge?
APR takes into consideration the overall cost of the loan, and if you were rolling off onto the variable rate. So you'll see the APRC is generally slightly higher than the interest rate. But yeah, it's the overall cost of the loan over the term of the mortgage. Okay.
We have a question. At what point in the mortgage process would you need to get a solicitor?
So you only need it when you go sale agreed. So you don't need it when applying for a mortgage, you know, or you don't need it when you have approval. But yeah, once you go sale agreed, what will happen is when you put your booking deposit down for that property, the estate agent will ask for your solicitor details, because that's when they send out contracts to your solicitor. So when you go sale agreed, that's when you only need a solicitor, and payment for a solicitor. So when you pay the legal fees, it's at the end of the process. You don't have to pay the solicitor the full legal fee or your stamp duty at the start. It's at the end of the process.
Okay. We have a few questions that are coming in on overpaying a fixed term mortgage.
Yep.
Can you break a 10-year fixed mortgage, and how does it work? What are the implications?
In regards to coming out of a fixed rate early or making overpayments?
Maybe both.
Okay, so we start off with overpayments. So the general rule regarding the lenders is that when you're locked in on a fixed rate, so we'll use a 5-year fixed rate as an example, you cannot overpay by a penny. You have to wait. If you want to make overpayments, you have to wait until your 5-year fix is up for maturity, and then before you roll in on a fixed rate or before you go on a variable, you can pay your lump sum off there and then. But there are some lenders that will allow you to make overpayments. You know, like KBC, for an example, they'll allow you to overpay by 10% during the initial fixed rate period. So if you drew down a mortgage of, let's say, €300,000 on a 5-year fix during those first 5 years, you can overpay by 30 grand. You know, there's no penalty, whether that's a regular overpayment doing a monthly or whether that's in a lump sum payment. So some lenders will allow you flexibility. Others won't allow you to overpay by a penny until your fixed rate's up. Once again, this is the reason why you'd come to a broker. In regards to coming out of a fixed rate, you'd have to check with your lender if you are locked in on a fixed rate. But most lenders will definitely charge you a fixed rate exit fee if you wish to come out of your fixed rate early.
Okay. So another good reason to turn to a broker.
100%.
There are questions regarding the home help to buy scheme. How likely do you think it will be extended, and how long will it last? How long will it be available?
It's due to end the end of this year, actually. Now, one thing that a lot of people probably don't know, and this is probably a concern from a lot of people, is the Help to Buy funds are paid to the developer's solicitor when you sign contracts with your solicitor. Okay, so for example, if you go sale agreed on a new build and you're availing of the Help to Buy in October 2021, but the house isn't ready until February 2022 when the scheme's end and you're thinking, I can't avail of this. Well, once you sign contracts before the end of 2021, you would have availed of the Help to Buy, regardless of if the property's ready in 2022. Okay, so that's number one, and I think not a lot of people know that, so I think it's a good point to make. Number two, my personal opinion, I do think it's going to be extended. As I said, it's there to help people get in the property ladder, and the government, more importantly, need to incentivise builders to build more. And as I said, I do think it's going to be extended for first-time buyers into 2022. But I don't work for the government, I don't work for revenue, so don't take that literally. But my personal opinion is, as I said, I think we need to build a lot more than we're actually building. So I think, for logical reasons, I think they will extend it.
Mm-hmm. Okay. A general question is, how much should people be saving for their mortgages when also renting? Because there's a concern that median salaries are this, and then the rent is high, and how much should you be aiming to save? Yeah,
so your repayment ability can be through either savings or rent. So there's no set amount that you need to be saving. Like whatever your mortgage payment is. So let's use the example that your mortgage payment is €1,200. If your rent is €1,000 per month, and that's shown coming out of your account, then you need to show a minimum saving of €200, because the €1,000 rent and the €200 savings per month will equate to the mortgage payment, and most lenders will be happy with it being saved that way. What I would say is, if you're getting your full deposit from a gift from a family member, if you're lucky enough to get it, bear in mind you can get gifted from a parent up to 335 grand tax-free throughout your lifetime. Okay, so a lot of parents I'm seeing nowadays, for their kids that are paying high rents, they're helping them out now, and it's tax-free. So if you're getting 100% of your deposit as a gift, ideally the lender wants you to have some money set aside, because bear in mind the cost at the end of the mortgage process is you have to pay stamp duty, which is 1% of the property price. So if you're going sale agreed at 300 grand, your stamp duty is going to be 3 grand. And then your legal fees, the solicitor fee, will be generally around 2,000 to 3,000. So you're looking at 6,000 on top of your deposit. So have some savings. The main thing the lender wants to make sure, whether you're renting or not renting, that through rent or savings, you can afford the monthly payment.
Very good. And could you say then the tax-free amount again that you are eligible to get, or
Yeah. So if you're lucky enough, I can't even get a point off my dad. So never mind 330 grand. But yeah, no, it's €325,000 tax-free towards the deposit. So if your parents willing to pay your full 10% deposit, the lenders are happy enough.
That's lovely, because that also covers another question that we had here.
If your parent was giving you 325 grand, you probably wouldn't need more.
That would be lovely.
Willing to help out in some way, then brilliant.
Yeah. Also, we had a question on the valuation. Who organizes the valuation, the buyer or the lender, and then the buyer pays for it?
It all goes through the lender, okay, but it's actually a mix. For example, with the likes of KBC and Permanent TSB, when you give me the property details in regards to go on sale agreed on, I send the instruction to them, and the lender picks a valuer in that area. Now, the valuer doesn't work for the bank; they're approved to carry out valuations on behalf of the bank, so they're independent. And then once they carry out the valuation, they ring the client for payment. And depending on the lender, the valuation fee can be anything between €130 and €185. But there are some lenders that on your approval letter, so the likes of Haven, who are the broker channel of AIB, they actually tell the client to ring up and organise their own valuation. But either way, you have to pay the valuer when the valuer completes the property or completes the valuation report. And as I said, €130 to €185, depending on the lender.
And you as a broker will probably have all the details on how much they charge, they charge.
Yeah. So literally, when someone goes sale agreed, I'm coming back to someone and asking, okay, what's the property address? What's the purchase price? What's the estate agent details? What's your solicitor details? And what rate do you want to go ahead with? Because we have to finalise now that your sale agreed. Do you want to go ahead with a 3-year fixed, a 5-year fixed, a 10-year fixed, a variable rate? What term do you want to go ahead with? Because you may have been approved on a 35-year term, but you might want to go with a 30-year mortgage. Everything has to be finalised then. And I'll advise, I'll organise the valuation now. You pay the valuer when they ring you. They'll send a report back to the bank, and I'll send all these details to the bank. And when everything's done, the loan offer pack will go out to your solicitor, and that'll allow you to sign contracts.
Lovely. And also, we have a cheeky question here. Can you keep betting in another account and not make them aware of it? So maybe we can talk about the legal requirements of showing all your accounts. Is there a legal requirement to do that?
Yeah. So there should be a financial obligation on everything. So if you have credit history abroad, you should be disclosing that. If there's any credit history issues, you need to disclose that. If there's money coming in from somewhere, the bank sees it, you have to disclose it. So it's just best being upfront. So the main thing is on any kind of accounts, if there's money going in and out of certain accounts, the lender will want to match up those transactions. So whether you feel it's relevant or not to disclose those bank statements, if the lender sees money going out to that, they'll be able to want 6-month statements on that account. It's not that they're being nosy, they're just trying to obviously get your full information.
Yeah.
But yeah, 6-month statements on all accounts.
Then we have some questions, and I'm gonna pile them together a little bit. So one part is about what income is considered. Is it the salary? If you have a bonus, is the bonus considered towards your salary? And also, if you're a PAYE worker, but also self-employed, so what kind of income is considered?
Yeah, once again, this is why you should come to a broker, because your bank might give you some information in regards to their credit policy. But as I said, we deal with 8 different lenders, so every lender is different. So it's not just a case of not going to a broker because of availability to get interest rates on bonkers.ie. It's more than that. We deal with every lender and we know their criteria. So I get this question all the time in regards to, I earn a lot of commission. Which lender's going to take the max lend? And I'll tell them, so generally lenders will take 100% of your basic pay. Well, they will take 100% of your basic pay. Depending how long you can show your overtime bonuses, commission, most lenders will generally take 50% of that. But some lenders will take 100% if you can prove it over a 3-year period. So every lender is different in regards to the variable income aspect. If you're a teacher and you have a qualification allowance, they're going to take that. if you've a location allowance as a HSE nurse, they're all going to take that, but every lender is different in regards to the variable income aspect, because every lender is going to take 100% of your basic, and then it's just a breakdown of your salary. And this is, once again, if you're earning commission bonuses overtime over 3 years, at that stage I might ask you for your 3 years P60 as well, just to show consistency of the earnings. And obviously I'm trying to squeeze as much out of the lenders to get you the mortgage you need. So it's not, I suppose, a straightforward answer. We do give you a salary cert to give to your employer to break down what your income is between your basic, commission, bonuses, overtime, etc. And as I said, I'll know from looking at that and your pay slips what I can get from each lender and advise from there.
Mm-hmm. And somewhat related question, if you were on the wage subsidy scheme mid 2020 and then you are entering a permanent employment, what the effect of the
so
subsidy?
They were on the wage subsidy last year, and
yes, and now from January on full pay from my company.
Okay, so if that person was still employed, I generally ask for a letter from the employer confirming when they went on the subsidy and when they came off it, and do they envisage themselves, are they affected by the latest lockdown? Okay, so it's just to give the lender that bit of comfort that they probably won't go on the subsidy going forward and they're back on their full pay. Because if we want to get them on the full pay, we have to give the underwriters and the banks comfort around that, but generally if you have 3 months pay slip showing you're back to your normal wage, I'm happy with that.
Mm-hmm. And what about credit history in Ireland? If a person has no credit history, how much this affects their ability to get a mortgage?
So a lot of people would be concerned in regards to credit history, in regards to I've never had a loan, a credit card, is that going to affect me? It was important to banks probably 10, 15 years ago that you showed you could pay back a debt. But once again, if you're meeting those 5 things on how to be mortgage ready, and you can show you can afford the monthly payment through your rent or savings, the lenders are happy with that. So don't be overly concerned, or don't feel you have to take out a loan before applying for a mortgage. Definitely don't do that.
Mm-hmm. What is your advice about fixing the rate for 3, 5, 10 years?
It's up to the person. It's basically how long do you want to be guaranteed that your payment to remain the same for? And that's a simple question. Do you envisage that if you're locking in a 5-year fix, can you see yourself moving within those 5 years? Because it wouldn't be smart to go on a 10-year fixed rate if you felt you were going to move after 5, because you'd have to pay a penalty to come out early. It simply depends what rate. Like obviously the lower the rate, so a 3-year fix would generally be lower than a 10-year fixed rate because you're paying the extra for that extra bit of security. So it simply depends how long you want to be locked in with that lender for, on that rate for, and that your payment to be guaranteed for. So it's up to the individual. If I ask 5 people that question, they'd be all different answers.
We also had a few questions on changing the lender during the mortgage and also changing the property under the same lender. So they're 2 separate queses.
So yeah, sorry, you could go through that again.
So how does changing the lender?
Okay, so that's probably someone looking to see if they could switch mortgage providers to get a better rate.
Yes.
So same process. It's still a mortgage application, unfortunately. So you will have to provide paperwork, but it's a lot easier to do. Because think about it, if you're looking to move provider to get a better interest rate, your proven repayment ability is you paying your existing monthly mortgage payment. As long as the figures work on the calculator, so if your income's enough to get you the mortgage you need, it's self-explanatory. You easily switch over, and you're fine. So it's easy to switch. Okay, the main thing is you need to be aware of, obviously, if you're locked in on a fixed rate, check if there's an exit fee from your provider. But a lot of lenders are incentivizing you to switch to them. So one lender, KBC, currently have an offer where they pay you €3,000 to switch to them. So if you're getting a better rate to save you money over the term of the mortgage, and they're giving you $3,000 to cover legal fees, because your legal fees and the solicitor when you're switching will be around €1,000 to €1,500. So if they're giving you $3,000, you're up already without seeing your monthly savings. And then over the mortgage term, you're gonna save a considerable amount of money as well. Because bear in mind, it's the biggest financial commitment you have going out of your house each month. It's the biggest bill you have. So what I'd say to anybody tuned in here is, if you're paying more than 3% on your mortgage interest rate, go onto websites like ccpc.ie, add in your figures there. So generally your mortgage balance, your property value, your term, and how much you're paying, and see what savings you can make. Or more importantly, reach out to a mortgage broker advisor and see if you can save some money. There's a lot of people paying 3% plus, and there's rates out there as low as 1.95%. So there's a huge variation that could save you a huge amount of money.
Mm-hmm. And what if you want to upgrade your property? So you wouldn't be a first-time buyer anymore, but is that a new mortgage application as well?
Yeah, it's a new mortgage. So what happened there is if someone, and it would have happened to a lot of people who maybe bought a starter property, so they might have bought an apartment and now they've had, let's say, I don't know, 2 kids since, and now need to buy a bigger home for themselves. So generally what happens is a second time buyer would need a 20% deposit. Okay, so first time buyer, you need 10%. So if you're buying a 300,000, first time buyer would need 30 grand. If you're a second time buyer and you're buying a 300,000, you need 60,000 euro. Okay, so it's the same mortgage application. If you're looking to move homes, the lender will look for what's going to happen in your current home. So are you going to hold on to that and rent it out? Or are you going to sell that in line with the purchase of the new property? And a lot of people don't know, you can use what's called your equity as your deposit towards the 20%. So equity is the difference between the property value that you own right now and the mortgage balance that you owe. So for instance, if you have a mortgage that's 100,000 and your house is worth 200,000, well, when you sell that, you'll have 100,000 left over, and that 100,000 euro can be used towards your deposit on the new home. So it certainly can be done. It will be a mortgage application. It will depend your income once again. Based on your income, you have to see what you qualify for. And then, as I said, the main criteria when you're a second time buyer is you need to have your 20% deposit. There are an exemption to that rule. So I touch base on the loan to income exemptions, which is when you're applying for more than 3.5 times your salary. A loan to value exemption is central banks state you need to have 20% deposit. But there's a thing called a loan to value exemption where you can look to pay 10% deposit as a second time buyer. Crucially, if you are looking for a loan to value exemption, you can't get a loan to income exemption. So you can't apply for 2 exemptions. But it is an option, a loan to value exemption, if you don't have your 20%.
Okay. And we had another question on the couples who are applying for mortgages after a divorce. Are they considered second time buyers?
Yeah. Yeah, or like if they're applying for a mortgage on a new home, yes, they've bought, like, if you've got a mortgage on a home, you're classified, your first time buyer status is gone. You know, you will be classified as second time buyer. So yes, obviously, very sad situation if someone's separated or divorced. But the same rules will apply. You still need the income to qualify you for the mortgage amount you need. You still need to show your affordability. You need to have a clean credit history. Your accounts need to be in order. But the main thing is, have you got 20% deposit? If you don't, can I get you a loan to value exemption where you're paying less than 20% deposit? But yes, you're classified as a second time buyer if you're looking to move home regardless.
Mm-hmm. Okay, we are getting close to running out of time, but there's a few questions that I would like.
I'm just looking at the amount of questions.
What do you think how the interest rates are going? Will they will rise?
Okay. It's a hard one because over the last 5 or so years they've been going down, and historically fixed rates were always higher than variable rates. Now the highest variable rate in the market is 4.5%, the lowest fixed rate is 1.95%, so fixed rates are actually considerably lower than the variable rate, and so it's a hard one to guess or put an estimate on. All I'd say is lock in on how long you want to be guaranteed that payment for if you're going for a mortgage anytime soon. So if you felt yourself that, look, I'm not going to lock in a 10-year fixed rate because I think house prices are going to go down, a lot of house prices, interest rates are going to go down. But it simply depends how long you want to lock in for on a fixed rate. I wouldn't be advised anybody going on a variable rate unless you felt interest rates were going to fall to the floor. And secondly, unless you plan on paying a considerable lump sum off your mortgage. It's kind of, most people are going with a fixed rate now because they're much lower. And some lenders offer flexibility to overpay. So to answer your question, it's a hard one to answer, but they have been going down over the last few years. And with 8 lenders on the market, there's increased competition. Avant entering the market there last year with a 1.95. That's going to kick the other lenders into gear and make them look at their interest rates. So you could see them going down slightly in the next year or so. But after that, who knows?
Okay, and last question. How does the drawdown procedure change when building your own house?
So yeah, the difference between, so when you just buy a house that's already built, whether it's a second-hand home or where it's a new development, you obviously pay your booking deposit to the estate agent. When you sign contracts, you pay the rest of the 10% deposit, whether that's through the Help to Buy, through a gift, or through your savings. And then the difference comes from the bank. So when your solicitor requests the funds at drawdown, that full amount goes to the vendor solicitor, and then you're a mortgage holder. The difference between a self-build is done in stage payments, okay? So usually the 4 stage payments. So if you're drawing down a 300 grand mortgage to do a self-build, you generally do it in a number of stages. You can do it in stages from 3 stages to 5 stages, or possibly more. But generally the architect or engineer, whoever's doing the build, will request a 4 stage payment. So you'll draw down your 4 stage payment, and let's say that's 100 grand. And that'll do the foundations, build the exterior walls, etc. Then when they need more money to continue to build, they'll ask for the 2nd stage payment. And then lastly, when the house is fully complete, a valuer will need to go back into the property, carry out a valuation, have a look around and say, the house is built now. We're happy that it was built in a compliant manner. They issue the check request through the solicitor and give a cert of compliance to basically say the house was built in a compliant manner. And then the final funds are issued. So it's issued in stages. And crucially, you only pay your mortgage payment on the stages that are released. So even though the overall loan is 300 grand, when you draw down the 4 stage payment at 100 grand, you're only paying your monthly payment based on 100 grand. So you're only paying the money on that you actually draw down. So it's done in stages. That's the key difference between a self-build versus just buying a house that's already built.
Okay, that's excellent. Thank you so much, Eoin, for joining us and for your presentation and addressing questions. That this is just so valuable, and it's an emotive issue for so many participants because they're trying to get a mortgage. And so thank you so much. I really enjoyed it, and I hope the participants did as well. So before we finish up, I would just like to take this opportunity to share the details of the final episode in the series of Money Talks, taking place on Tuesday, 23rd of March at 1 p.m. So the times of the different is 1 p.m. Featuring Eoin McGee as he gives his advice and tips on investing and making our money work for you. And you will get the link to register in the chat section. Also next Thursday, 25th of March at 7 p.m. We have UCD in Conversation virtual event series where that will feature a discussion on transforming Ireland's energy sector with Professor Andrew Keane, Director of the Energy Institute, and Paul Manning, Co-founder and Chief Commercial Officer for NovoGrid. And that will be moderated by PJ Rudden, founder of Angus Consulting Limited. So if you would like to join, the registration link is in the chat. So thank you so much, Eoin, and to all our attendees and your questions. And we hope to see you next week for the final episode. Thank you.
Thanks, Anita.